Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. As you know, in my channel I look at the respectable value investors and I study great businesses. Today we will be looking at the 3 investing rules identified by Benjamin Graham. Warren Buffett is regarded as the best investor of all time, but if you ask him who he thinks the greatest investor of all time is, he would most likely choose his teacher Benjamin Graham. Graham is widely regarded as the father of security analysis and value investing. He was an investor himself, an investing guru by any stretch of the imagination. In this video, we'll be taking a look at the top 3 investing strategies by Benjamin Graham, so let's get straight to the point. Rule number 1, always invest with a margin of safety. The notion of buying an asset at a considerable discount to its intrinsic value is known as a margin of safety. It's regarded to not only create high return chances, but also to reduce an investment's negative risk. Graham's objective, in basic terms, was to purchase assets worth $1 for 50 cents. He did a fantastic job at this. These company assets might have been significant to Graham because of their consistent earning capacity or because of their liquid cash worth. Graham, for example, was known to invest in firms whose liquid assets on the balance sheets, net of all debt, were worth more than the company's whole market valuation, also known as net nets. Graham was practically buying businesses for nothing as a result of this. This was Graham's normal investment approach, despite the fact that he had a variety of others. This is an important idea for investors to understand, since value investing may result in significant rewards. Once the market reevaluates the company and raises its price to fair value, it also gives protection on the downside, in the event that things don't go as planned and the company fails. Graham's success was built on the safety net of buying an underlying firm for a fraction of its true value. When these inexpensive equities were properly picked, Graham discovered the additional declines were rare. While several of Graham's pupils were successful utilizing their own methods, they all agreed on the need for a margin of safety. Rule number 2, expect volatility and profit from it. Dealing with volatility is part of investing in stocks. Instead of fleeing the market in times of stress, the astute investor views the market downturn as opportunities to locate fantastic assets. Mr. Market provides investors with a daily price tag at which he will either buy out or sell his part of the company. He will occasionally be enthusiastic about a company's future and quote a high price. Other times, he is pessimistic about the company's future prospects and offers a cheap price. The lesson here is that you shouldn't let Mr. Market's opinions dictate your own emotions, or worse, lead you to financial decisions, since the stock market has these same feelings. Instead, based on a solid and objective evaluation of the facts, you should make your own assessment of the business's value. Additionally, you should only buy when the price offered is reasonable and sell when the price gets excessive. In other words, the market will vary sometimes violently, but instead of fearing it, utilize it to your advantage to find bargains in the market or to sell out when your assets become significantly overpriced. Graham proposed 2 ways to alleviate the detrimental consequences of market volatility. Number 1, dollar cost averaging. Dollar cost averaging is done by purchasing investments in equal dollar amounts at regular periods. It takes advantage of price declines and eliminates the need for investors to acquire an entity of his or her stake at the market's peak. For passive investors, dollar cost averaging is beneficial since it relieves them from the task of deciding when and at what price to acquire their investments. Number 2, investing in stocks and bonds. Graham advocated for balancing one's portfolio between stocks and bonds to protect money during market downturns while still obtaining capital growth through bond income. Remember that Graham's idea was to protect money first and then to strive to develop it. He recommended investing 25 to 75% of your money into bonds, with a percentage shifting depending on the market conditions. This method also had the added benefit of preventing boredom, which can lead to the desire to engage in unproductive trading. Rule number 3, know what kind of investor you are. Investors should be aware of their own investment. According to Graham, to demonstrate this, he created obvious contrasts between major stock market groupings. active and passive investors, which are referred to as enterprising investors, and defensive investors. According to Graham, you only have two actual options. The first is to devote a significant amount of time and effort to become a skilled investor who considers the quality and quantity of hands-on research when calculating the projected return. If this isn't your cup of tea, settle with the passive, potentially lower return in exchange for significantly less time and effort. The academic concept of risk equals reward was thrown on its head by Graham. Work equals return is how he sees it. The more time and effort you put into your investments, the better. Investing in an index is a fantastic option if you don't have the time or willingness to undertake thorough research on your assets. According to Graham, the conservative investor might obtain an average return by buying the Dow Jones Industrial Average 30 equities in equal proportions. Both Graham and Buffett agreed that achieving even an average return like the S&P 500 is more difficult than it appears. According to Graham, many people believe that since it's so simple to earn an average return with little or no effort through indexing, then a little more effort should provide a somewhat greater return. The fact is that the majority of individuals who do this do significantly worse than the average. In today's words, a defensive investor would be someone who invests in stocks and bonds and index funds. In essence, they control the entire market, profiting from the best performing sections without having to anticipate them ahead of time. By allowing the stock market's overall outcomes to govern long-term returns, an investor is essentially assured of the market's return and avoids doing worse than the average. Beating the market, according to Graham, is far easier said than done, and many investors still fail to do so. There is another category of investor type, speculator versus investor. Not everyone who works in the stock market is an investor. Graham thought that determining whether people were investors or speculators was crucial. The distinction is simple. An investor considers a stock to be a component of the firm, and a shareholder to the owner of that firm. But a speculator considers himself to be gambling with pricey pieces of paper with no inherent worth. For the speculator, the asset's worth is solely decided by what someone is willing to pay for it. To paraphrase Graham, there is intelligent speculating and intelligent investing. The trick is to know which one you're best at. Benjamin Graham is a very experienced investor, and he's the teacher of a well-known Warren Buffett. So he clearly has some tricks that he can make sure to succeed in investing. Thank you so much for watching, and if you like this video, please share it with your friends and family. It helps the channel a lot. Leave in the comments section your thoughts about the next video and who we should cover next. With that said, thank you guys so much for watching this video, and I'll see you in the next one.